The S&P 500 briefly falling below 5,000, now just above that level. The weaker GDP print coming on the heels of Meta's lackluster earnings report, which has also put some pressure on tech. You've got the NASDAQ now falling just about 1.4% on the day over the last 5 days, off just about 0.7%. We want to bring in Binky Chadha, Deutsche Bank's Chief Equity and Global Strategist. Binky, it's great to see you here. So let's talk first about that GDP print, because that is a big driver here of the markets today. Lots of questions about what exactly this could signal. We're seeing the reaction in yields play out. How are you looking at today's print?
So what I would argue is that there's actually, very little to take away from the GDP print, and I think it has, very few implications basically going forward. And if anything, I'd argue it's positive. So what do I mean? If you take the GDP print and you start thinking about, the components. The largest component, of course, is personal consumption expenditure, PCE, and that's close to 70% basically of GDP. That came in at 2.5% growth. Believe it or not, that happens to be the 10-year trend. So that's why I say there's not a whole lot to take away from the largest component. If you think about the second very important component, especially basically, at a cyclical turning point, which is what we think we are at, that's really investment spending. That's telling you about, corporate confidence, how corporates think about the future. And CapEx really, has come in basically better than most people expected. The housing part actually looks also like it's recovering. So we have consumption at its 10-year trend. We have growing at its 10-year trend. We have basically investment picking up. So, slightly better than expected, but in line with the view that we are turning up. So why do we get this bad print? It's, coming from basically primarily the two largest, noisiest components of GDP, which are basically inventories and the trade balance, because we measure them as contributions to growth. So, if you take a quick look at what the trade balance did to GDP, it took off 4.5% from the headline number. I think people forget that GDP is a very volatile number. The quarterly vol is about 1.25%. And if you're talking about trend growth of 2.5%, that's a rather large proportion of noise. So not taking away too much, I think growth, is really about consumption and investment responding basically to the outlook for consumption. And those two major components look absolutely fine.
So Binky, is this a bit of an overreaction then when you take a look at the fact that we are seeing a bit of a sell-off here in the markets and we are seeing yields spike?
I would say it's in keeping with the market's behavior, which was impacted hugely by 2022. But I would remind that we are in 2024 now, but the market is still, very much, if we have good growth or strong growth, that means higher inflation. I would disagree. I would say, yes, of course, growth matters for inflation, but the growth that we've had has not mattered for inflation. If you think about, inflation relative basically to growth, which I would measure as basically by unemployment. I mean, we've been studying for about 2 years, give or take decimal points here and there. So it's not really coming from, the main driver in the so-called Phillips curve, which actually works rather well in explaining inflation historically, we would argue, or the other big driver of inflation, which is the U.S. dollar, which is, as high as it is, basically at the top of its bands. It is all really coming from outside. And it's really about U.S. inflation, and because U.S. growth has been stronger than the rest of the world, there's a tendency to believe that basically, that inflation is coming from the very strong U.S. growth. What I would point out is that these are pretty strong consensus and read and view, sort of across basically economists, the market, the ECB, that European inflation, is behaving well. It's well on its way down to the target of 2%. And the market's priced in, and the ECB's told us they're going to cut rates in June. It's important to keep in mind that Europe uses a price index called HICP. It's the Harmonized Index for Consumer Prices. Well, the HICP also exists for the United States. And if you look at the HICP for the US, it actually, got down to 2% before it did in Europe. And it's been sitting at 2% since June, July of last year. So we're in 9 months of 2% inflation. The US indices, the CPI and the PCE, of course, running higher. And I would argue that the main culprit there is, owner's equivalent rent, which is an imputed price. Nobody pays it. And that's what's keeping U.S. inflation measured by our, indices that we focus on. Whereas if you looked at U.S. inflation in European terms, you would come to the opposite conclusion that, European HICP core inflation is actually catching down to U.S. inflation.
So, Binky, let's talk about then what is ahead. Given all that, given some of the trends that we have been seeing, I want to bring up a chart that we've been following very closely here at Yahoo Finance. It was initially included in Yahoo Finance's chart book a few months ago, but it's still relevant today. And it's comparing where the GDP prints or projections have been relative to consensus. And we have seen this catch-up trend play out here over the last several months. Is this something that you expect to continue here for the coming quarters or coming months?
We got a poor print today, so I expect that nobody's going to be in a hurry to raise their growth numbers. I think underlying GDP growth in the US is, about 2.5%. And I think that simply because if you look at the largest component, and this is something that I mentioned earlier, if you look at the largest component, which is personal consumption expenditure, and as I pointed out, it's about 70% of US GDP. It's growing steadily in a trend channel at 2.5% annual rate. It was doing that for the 5 years before the pandemic. We had, of course, the pandemic blip down. We had a recovery back into exactly the same channel. And if you started, by looking at the data and the largest component, there's actually nothing to see there. It's doing what it's been doing. And that's why I call it a 10-year trend of 2.5%. So I would argue, relative to the chart that you put up, which was this, sort of 6-quarter roll forward of imminent slowdown around the corner, there had been basically an improvement, but you can still see the gentle sort of, down move. So I would argue, the macro consensus has sort of remained cautious to pessimistic and sort of, and I expect with today's print, it will remain so. But I would argue that provides an opportunity because underlying growth does look stronger, as I mentioned.
All right, Binky Chadha, always great to get your insight. We look forward to having you back here soon. Binky Chadha, Deutsche Bank's Chief Equity and Global Strategist. Thanks so much.
Thank you.